By now, you know my love for the ETF SCHD. It's one of the most well-balanced ETFs around. It has faster dividend growth than many dividend growth-focused ETFs. It has a higher yield than many high-yield focused ETFs. And the performance speaks for itself. And that's why it sits towards the top of my portfolio. But it's not all I own and not all we should focus on. And in today's video, we're not going to be talking about SCHD. Instead, we're going to be talking about 4 other ETFs that you should look into buying before 2025. Now that the Federal Reserve has cut interest rate, expect things to change in the market. Things can get a little bit more bumpy and look a whole heck of a lot different. So before we dive into each of these ETFs, do me a huge favor. Show your appreciation by clicking that like button down below. I truly appreciate it, and consider subscribing to the channel. And let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is the Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, you can check out their 10 best stocks to buy by going to fool.com/Mark. You can also check out the link down in the description below. All right, let's jump back into our video, taking a look at 4 ETFs not named SCHD, beginning with ETF number 1, which is the Schwab US Large Cap Growth ETF, also known as SCHG, kind of a sister fund. So if you're out there looking for mega cap exposure, large cap and growth exposure, this is going to be a great ETF for you. But the thing that you're going to want to do first is take a hard look at your portfolio. If you have a portfolio that is largely geared and you're overexposed to the likes of the S&P 500, the QQQ, and all of those Mag 7 growth stocks, this ETF here is only going to further put you into that overexposure rate. When it comes to building long-term wealth, it really comes down to having a well-balanced portfolio. You don't want to be overexposed to where you have 70, 80% of your portfolio in only 1 or 2 sectors. So be mindful of that as you manage your own portfolio. When taking a closer look at SCHG, you can see that they have assets under management of $33 billion. And over the past 12 months, shares have climbed nearly 40%. Looking out even further, over the past 5 years, they have climbed 150%. If you're like me and continue to believe that these Mag 7 stocks can outperform the market moving forward, regardless of rates coming down, then SCHG is going to be a fantastic ETF. I am looking for more exposure, but I want exposure to the best growth stocks, the largest growth stocks, and that's exactly what this ETF does. Looking here, you can get a sector breakdown, which should come as a no surprise to see technology and communication services at the top, accounting for 51% and 13% respectively, followed then by consumer discretionary, healthcare, and financials rounding out the top 5. Here's a look at the top 10 holdings, where you see Apple, Nvidia, Microsoft, Amazon, Meta, both classes of Alphabet shares, Broadcom, Eli Lilly, and Tesla. These top 10 holdings account for 60% of the ETF. So that right there speaks volumes. Although this is an ETF with more than 200 holdings, 60% of this ETF is exposed to those top 10. Apple, Nvidia, Amazon, Broadcom, Alphabet, Meta. These are the companies I'm looking for more exposure to. And if that is you, SCHG is going to be a fantastic ETF. And that brings us to ETF number 2, which is going to be the iShares Core S&P Small Cap ETF, otherwise known as IJR. So with interest rates coming down, this is going to be a very positive catalyst for small caps. They are interest rate sensitive to a degree. However, when it comes to looking at small caps, I'm not a big fan of having exposure to all small caps. Why? Because there's a ton of them out there that are poorly run. There's a ton of them out there that make zero in profit. What IJR does is it focuses on the largest small cap stocks, the higher quality small cap stocks, more of the profitable small cap stocks. IJR has assets under management of $84 billion, and over the past 12 months, shares are up 23%, and over the past 5 years, up 51%. That 5-year performance is half of what the S&P 500 has returned over that period. Again, small caps have been weighed down by higher interest rates, and there's a lot of risks that come with small caps. A lot of these companies are small for a reason, so we have to know that going in. But again, there's a lot of poorly run small caps. So that's why I don't want as much exposure to something like IWM, which has over 2,000 holdings. When we're investing in IJR, it's focusing on just 600 companies. Looking here, you can see the sector breakdown, which is rather well balanced. At the top, you have industrials, followed by financials, consumer discretionary, technology, and healthcare. Here's a look at the top 10 holdings of the ETF, with no real dominant position, as the exposure is well spread out over all 613 total positions, and the top 10 only makes up nearly 7% of the ETF. Investing in small caps comes with added risks, but there's also huge potential now that interest rates are starting to come down, and IJR is the way I'm going to play it. This is an ETF within my portfolio, and if you're ever interested in seeing my entire portfolio, then subscribe to my newsletter and Discord community, the Stock Investor's Edge, where you can find deep dives, my own portfolio, trade alerts, all within our Discord community. See the link down in the description below. And that brings us to our third ETF, which is going to be the Schwab US REIT ETF, stock ticker SCHH. Continuing on with the theme of lower interest rates, another area that benefits is going to be the real estate or the REIT sector, which is very highly sensitive to higher interest rates. Now, if you've been watching my channel for a good amount of time now, you know that back in the summer months, I was talking about starting to invest in REITs, get some more exposure to REITs, because now we're going to start talking about interest rate cuts. And lo and behold, if you look back over the past 3 months, what has happened? REITs have been one of the top performing asset classes in all of the S&P 500. And for a while, the next closest sector was only half of what REITs were doing. So if you have a lack of exposure to this particular sector, SCHH is a great way to increase that exposure. And when we take a closer look here, you can see that the ETF has assets under management of $8 billion. And over the past 12 months, shares have climbed 25%. However, over the past 5 years, down 4%, as REITs have been the worst performing sector the past 18 months, due in large part to high interest rates. But now we're starting to see that reverse. When you look at the REIT sector, dating back all the way to the 1970s up until we hit a global pandemic, the REIT sector had been a top performing sector, outpacing the S&P 500 since the 1970s. That's the data we want to focus on, not the one that derails it because we have high interest rates due to a global pandemic, due to high inflation. Now we're starting to see things revert back to normal, and I expect the real estate sector to start moving back higher. Looking here, you can see the sector breakdown, which, given that this is a sector-specific ETF, it shouldn't surprise you to see 100% focus on real estate. And I should also note that SCHD does not invest in any REITs, so you will not have any exposure if you are investing in SCHD. Here's a look at the top 10 holdings, which include the likes of PLD, American Tower, Equinix, Welltower, Public Storage, Realty Income, Simon Property Group, DLR, Crown Castle, and Extra Space Storage. These top 10 holdings account for nearly 50% of the ETF. I like this REIT ETF because it's more focused on the top 10 holdings and not as broad in terms of total holdings overall. Very similar to the same reasons why I like IJR. I'm not looking for broad exposure because, again, there's a lot of poorly run REITs out there. I want to focus on the best of the best in this particular sector, and SCHH does a fantastic job doing just that. And that leads us to our fourth ETF, which is the Vanguard Value ETF, stock ticker VTV. And if you watched my video back in mid-August, this is an ETF that I mentioned buying. And since that video came out, this ETF has climbed nearly 10% in a short amount of time. And the reason I like this ETF, even to this point, is the fact that it is a great complement to those high growth, higher risk, more volatile type positions you may own. This does a better job of balancing out your portfolio. Taking a look here, you could see the ETF has assets under management of $186 billion, easily making it the largest on our list today. And over the past 12 months, shares have climbed nearly 30%, and over the past 5 years, they are up 60%. So with VTV, you are still getting large cap companies, high quality companies, just less exposure to technology, less exposure to communication services. And speaking of sectors, let's take a look at those right now. Looking here, you can see the top sectors, which include financials, healthcare, industrials, technology, and consumer staples. The top 10 holdings include Broadcom, Berkshire, JP Morgan, United Health, ExxonMobil, Procter & Gamble, Johnson & Johnson, the Home Depot, AbbVie, and Walmart. These top 10 holdings account for 23% of the entire ETF. And looking at these positions here, they essentially have very little to no overlap with any of the other 3 ETFs that I mentioned today. And that was the whole goal of today's ETF, to give you 4 ideas that could go all together, or to give you 4 high-quality ETFs for you to pick and choose from. Down in the comment section below, let me know which of these 4 ETFs is your favorite of this list. And if you haven't done so yet, make sure you smash that like button down below. Subscribe to the channel, and we'll see you in the next one. Take care.